We are living in an era of unprecedented global borrowing, a system built on the perpetual promise of future repayment, a world where debt is not merely a tool for trade, but the very fuel of civilization itself. From the clay tablets of Mesopotamia, where kings struggled to manage peasant debt, to the digital ledgers of Wall Street, the human addiction to borrowing from the future has defined our history. But today, that addiction has reached an unimaginable scale. The global debt complex, across governments, corporations, and households, is estimated to have reached a record high of USD 338 trillion in the first half of 2025. This number is so large it barely registers, like trying to comprehend the distance to a star. This debt mountain, coupled with an aggregate global debt-to-GDP ratio stabilizing just above 235%, is a structural monument to financial unsustainability. This documentary is a forensic analysis of the $300 trillion question. When this debt finally breaks, who pays the price? Who is protected and who is crushed? History does not repeat, but it rhymes with a cruel consistency. Every bubble feels unstoppable until it bursts, and the people who believe it can only happen elsewhere are always the first to be crushed. We will expose the three critical vectors of failure already in motion and reveal the mechanism of risk socialization that guarantees the wealthy will be saved and the global taxpayer will be left footing the bill. To understand the inevitable collapse, we must first accept the scale of the imbalance. The current debt load, over $338 trillion, is structurally unsound in an environment of elevated real interest rates. For decades, the system survived on cheap credit and low interest rates, enabling governments to borrow endlessly and corporations to sustain unprofitable models. Now, that era of free money is over. History provides ample warning. No empire, no nation, no system has escaped a reckoning with debt. Ancient Rome's strength rested on the silver denarius, but bloated spending and endless wars led emperors to debase the currency, mixing silver with cheap copper until the coins were nearly worthless, shattering trust and power itself. France, by the late 1700s, found that interest payments consumed over half the national budget, leading directly to financial collapse and revolution. Mexico, in 1982, shocked the world by declaring it could not pay its debt, plunging Latin America into a crisis that granted enormous leverage to the IMF and Wall Street. The U.S., too, sits atop record debt, with its political system addicted to spending more than it earns, ignoring the warnings of history. The structural failure is not an external threat. It is an internal mathematical sickness. The current analysis confirms that a systemic crisis is not a distant contingency, but a function of time, driven by the concentrated refinancing deadlines facing both advanced and developing economies between 2025 and 2027. The political choice to delay discipline and perpetually borrow more guarantees the eventual failure. The first and most visible vector of failure is the inability of governments worldwide to service their massive debts, especially as rates remain elevated. The world's emerging markets and developing economies, EMDEs, face intense vulnerability. While their public debt to GDP averages around 80%, their major risks are foreign currency debt. Much of their debt is denominated in US dollars or euros. Any appreciation in the dollar or spike in U.S. interest rates translates directly into a catastrophic increase in debt servicing costs. High refinancing needs. These countries face high refinancing deadlines between 2025 and 2027. If they cannot roll over their debt, external default and severe currency crises are inevitable. Historical precedent. This situation precisely mirrors the Latin American debt crisis of the 1980s, where nations like Argentina and Mexico were forced into default and subjected to the IMF playbook, austerity, privatization, and national sovereignty loss, all to ensure foreign creditors were repaid. Countries like Sudan, Venezuela, and Lebanon, already suffering from extreme political instability and commodity reliance, exhibit extremely high debt vulnerability, with government debt to GDP exceeding 160%. Even advanced economies, AEEs, face systemic risk. Japan's government debt stands at a staggering 230% of GDP. While primarily financed internally, this debt level presents a slow-burn fiscal erosion and significant internal financing risk. More critically, countries in the Eurozone periphery face a severe sovereign bank nexus risk. This means the asset quality of domestic banks is dangerously tied to the health of their own government's sovereign debt. If a peripheral Eurozone nation faces severe stress or default, the local banking system collapses immediately, leading to restricted lending and forced deleveraging across the economy. This confirms that debt crisis contagion is not a theory. It is a guaranteed mechanism for spreading systemic failure. The second major vector of failure is hidden in the opaque world of shadow banking, particularly the rapid growth of the private credit market. The private credit market has ballooned in size, largely operating outside the stringent regulatory oversight applied to traditional banks. This lack of transparency and rapid growth creates systemic vulnerabilities. Concealed losses. These shadow intermediaries conceal losses for far longer than regulated banks. Because their assets are illiquid and are not marked to market daily, losses remain hidden until a sudden liquidity event, such as a mass redemption or major refinancing failure, forces abrupt markdowns. The illusion of safety. This opaque market contributes to the illusion that the financial system is healthier than it truly is. Every bubble promises easy wealth, and every crash punishes those who believe the illusion. The modern financial system, built on fractional banking, is a house of cards that tumbles when confidence cracks. The entire global debt structure, including shadow credit, functions like a legal pyramid scheme. The system only survives if more people keep entering new debt and if old promises are paid with new money. The sheer size of global debt, crossing $300 trillion, is mathematically impossible to repay without collapsing demand. Instead, the burden is pushed forward, ensuring dependency and perpetuating the cycle. Private credit is merely the newest, most leveraged layer of this global pyramid. The third systemic risk is the severe concentration of exposure within the commercial real estate (CRE) sector. The CRE market is facing intense pressure due to high interest rates and structural shifts, remote work, retail decline. Many institutional investors, including pension funds and insurance companies, have high concentrated exposure to CRE debt. Non-bank risk, vulnerabilities in non-bank CRE investors amplify the systemic risk. When refinancing deadlines hit and property values fall, this concentration of risk can trigger widespread losses throughout the banking system and the shadow finance complex. The 2008 echo. This mechanism echoes the 2008 crash, where toxic mortgages and debt were sliced into invisible global products and sold worldwide, leading to a meltdown when the underlying reality of housing values failed. The lesson from 2008 remains clear. The system survives by sacrificing the middle class and socializing losses. The $300 trillion question is ultimately answered by the political architecture of modern finance. The primary goal of the system is self-preservation, which dictates precisely who gets crushed. The history of every major financial disaster, from the panic of 1907, the rule of hostage. Banks and large financial institutions hold the global economy hostage. If they collapse, the entire economy collapses. Therefore, laws and bailouts are designed to protect them first. The socialization of risk. The eventual break will be amplified by this structure. Private sector losses, stemming from high leverage in private credit and CRE, will be converted into public debt via massive government bailouts and regulatory forbearance. The ultimate distribution of this failure is a classic example of risk socialization. Those who enjoyed the private sector profits of the boom, banks, creditors, asset owners, will have their losses absorbed by the public. The burden is immediately transferred to ordinary people and future generations. The taxpayer. The losses become a burden on future taxpayers, who must service the resulting public debt. This is a debt imposed for mistakes they never made. The saver. The state's response to crisis is inevitably to print money, QE, monetary dominance. This fuels inflation, the silent tax that systematically destroys the purchasing power and life savings of the middle class and the poor. As prices explode, real wages stagnate, and the wealth gap widens. The worker. Sovereign defaults and banking crises have an employment cost. When debt breaks, job losses follow, creating mass unemployment and political instability. The ultimate cost is measured in lost homes, jobs, and shattered trust. The $300 trillion question confirms that the system counts on your ignorance and fears your awareness. Financial education is not optional. It is the only shield against being exploited by the same dynamics that crushed ancient populations. You must understand the Cantillon effect, the law that governs the flow of money in a debt-based system. When new money is created, printed, it flows first to the banks, the government, and the asset owners. By the time it trickles down to the general populace, its value has already been diluted by rising asset and commodity prices. Positioning. Prosperity follows knowledge of cause and effect. You cannot stop credit creation, but you can move closer to its source by owning assets that benefit from early liquidity, such as productive businesses and scarce commodities, while minimizing liabilities. The system rewards debtors over savers, owners over earners. When money fails, the paper promises vanish first. History shows that the families who survive every collapse hold wealth in things that cannot be printed away. Tangible assets, land that grows food, skills that produce value, tools, gold, and silver. These are the real assets that endure. Mindset. Financial freedom is not having more. It's needing less, mastering desire, and staying in control when fortune turns. This Stoic philosophy offers the only financial armor that never fails in a crisis. The failure of the $300 trillion complex is not merely an economic forecast. It is a profound political choice. The choice is whether the system will reform itself or destroy the trust of its citizens through mass risk socialization. Based on history, the latter is the established playbook. The ultimate question is this: when the final balance sheet is tallied, will you be the creditor who saw the warning, or the taxpayer left paying the cost of someone else's greed? History has already written the script. If you fail to understand it, it will crush you all the same.